The credit crunch has started. And what does this mean for commercial real estate? Because it is impacting it the most so far in the near term. What does this mean for your banks, your deposits, your investments in the market, and how are you going to navigate this environment? So let's get right in so I can paint a picture for you on how this environment I predict is going to be playing out and what we can do to prepare ourselves against this coming crash. You've reached the Financial Almanac. I'm your host, Basil, and let's get right into this. Warren Buffett just had his Omaha meeting for Berkshire Hathaway shareholders, and during this 5-hour meeting, there's a lot of stuff that actually overlap with the coming credit crunch and the commercial real estate collapse that we're about to see contract a little bit, according to Buffett. Now, Buffett does think cheap money has gone and passed. The environment today is completely different. He expects from 6 months ago, from a year ago, and what he sees in his retailers and his supply chains is that they have oversupply on goods. What happens is it's sitting there in warehouses. They have to discount it to get it moving before expiration date and before, the economy gets a lot worse. He does expect there to be a recession in the second half of this year where it begins, and then later on it might get a little worse as he expects. So he wants to move the product quickly while he still can. Not only that, but also, Fed President of Chicago, Austin Goolsbee, also has shared that he expects there to be a credit squeeze that will basically slow down the economy. So considering what Warren Buffett has said and Austin Goolsbee, here at high interest rates from the federal funds rate, credit contraction being predicted because borrowing standards are tightening, people have to be more credit worthy in order to borrow from the big banks. Going back to the credit crunch that's causing the commercial real estate market to contract, what I see is there's going to be a lot of loans that will not be able to renew, essentially, right? We have credit conditions tightening from banking standards. We just had the interest rate for borrowing increased. What happens is there's a lot of froth in the market just because back in the day, venture capitalists used to, when I mean back in the day, I mean during the recovery of COVID, right? Venture capitalists would come up to a small business that's sort of starting up and saying, hey, how much does your stuff sell? They'll say, $10. And the guy's like, okay, perfect. Venture capitalist is saying, here's, $15, go basically swarm the market. I know I'm losing initially, but you just want to spam the market to the point where you get brand recognition. And then the idea back then by venture capitalists was you'd have opened up the market. They would recognize you and that would create loyalty and reoccurring customers for you. And that would sort of give you a tail end of profits. That's not happening anymore. Obviously, that was a terrible strategy because a lot of these markets, a lot of these VCs and small businesses that had this kind of tactic didn't do so well during the pullback from June 2022, even back when things were really amazing at the peak of the market back in November 2021. So we see a lot of that strategy didn't work anymore, and that credit's sort of still sloshing around. And so with the increased rate hike that happened, credit contraction is coming down, and a lot of basically fees and profits that regional banks have are from borrowing standards, right? And from interest payments made by commercial real estate. And a lot of those commercial real estates won't be able to afford those properties because of what happened in COVID. Everyone working from home has actually saved a lot of companies the expense of operating at a certain location, paying rent, paying those electricities. A lot of companies still have those properties just in case they want that back in office, face-to-face workplace environment. But a lot of other companies slowly said, no, we're not going to renew. We no longer need these offices. A lot of cutbacks were made. Now we're seeing with the increase of property rents and borrowing rates and employees asking for more wages, it's putting a lot of pressure on office commercial units, and it's harder to make payments. And so what will happen, we'll see a wave of initial layoffs regarding the renewal of these properties coinciding with these layoffs, and that's going to create a whole leg down into the market. And when commercial real estate basically numbers take effect, that's going to affect the regional banking system, because about 40 to 60%, depending on the regional bank, that's usually like the body, there's also standard deviations from there, but are holding office, commercial real estate. And when they don't make payments and they tend to default or not renegotiate their loan, that puts a lot of pressure on the operation of keeping these regional banks up and going, right? So there's going to be a lot of bailouts. If not, the FDIC will kick in. If not, mergers and acquisitions will come in at a discount to pick up their assets and liabilities, to concentrate the banks into even a smaller, maybe 3,000 rather than 4 and change thousand, right? So that's basically what's going to be what I predict is seeing happen. With this coming credit crunch that we're expecting, causing the commercial real estate to be drawn back, there are some major institutional players that also have shared this sentiment as well. We have, the Union Bank of Switzerland, UBS. We have Morgan Stanley releasing a press release saying that they do expect this to be greater than the Great Depression in terms of contraction. We also have Goldman Sachs chiming in on those. And so we have this consensus in the market. Not only are we going to enter a recession, but the commercial residential unit is going to be one of the first things to fall in this domino effect. Now, these institutional analysts do expect there will be this drawdown for mainly a few reasons. For example, one of their strongest points that they've made is that, when commercial real estate loans are made, they're not like residential. They're not 30-year mortgages, right? They are shorter term amortization, meaning in a few years, if not this year, the one right after, they will come up for renewal. And at this higher interest rate that we're facing, and that market contracting with lending standards, a lot of them might not be able to renew. They expect up to 50% of the contracts that are out there coming up for renewal not be able to be met and renewed. So it's very important to keep an eye out for the next 24 months, because this might be a lot worse of a contagion than we actually expect. And that supports my outlook on the economy going into a severe recession. But that's essentially just assuming that the Federal Reserve keeps their federal funds rate high and does not pivot. And their second point that they're brought up is something I've also touched on earlier, where there's a lot of vacancies in the commercial units and landlords have to pay up because they have no renters. For example, Blackstone, one of the biggest commercial real estate holders out there, right? Landlords, they have reported last quarter huge amounts of losses. We have another institutional player, Brookfield. They've had a lot of office loans also default. So when we have Blackstone reporting earnings in last quarter with huge losses in their earnings, and we have Brookfield here defaulting on their office loans, and those are the big players, those are big scale players, it's not really the reassurance we need to say commercial real estate is off to a good start, and a lot of the bank holders for the smaller players rather than institutional players are regional banks. And we're already having a regional banking crisis, right? During this credit contraction, that's even going to be more severe because we just had the rate increased, meaning the banks still are going to be contracting even more. So when we look at the commercial real estate for Blackstone and Brookfield, we see Blackstone basically cut down on their profits from 9-point-something billion to 4-point-something billion. That's a 50% loss in profits. Yes, they're still profitable because they own such a large amount of the monopoly out there. But man, oh man, I gotta say, that's not a good start, especially since this was just within the last year and the real dominoes taking place hasn't even begun yet. And we also see Brookfield lose and default on $161 million of commercial real estate tied to office properties. Not only that, but Bloomberg reported like a couple weeks ago, I think it was maybe last week actually, where Brookfield has actually defaulted and lost $764 million with 2 office property towers in Los Angeles. Gone. Just like that, 784 million if memory serves. So we're seeing huge players already having vacant offices that they still have to keep payments on their loans, right, on their debts. And how are they making revenue when there's no occupancy? Not only are we seeing these massive institutions basically default on large real estate loans, we're also seeing regular people that actually have commercial real estate, specifically office properties, not have any renters in there. It's completely vacant. And here comes their contracts for renegotiation, for renewal, and the interest rate is higher with no occupancy. How are they going to make payments? And those guys are not like, Brookfield or Blackstone. They're going to their regional banks. And the regional banks are putting a lot more pressure on the renewal for these, day-to-day landlords while they have, office properties without occupancies. Yeah, there's going to be a lot of defaults. So a lot of the landlords actually have a lot of pressure on them because, while their properties, yes, are vacant, they still bleed money. For example, office properties a lot of times hire a management team to facilitate and maintain the property. So there's the management fees that they have to pay, and then the maintenance fees they have to pay. They also have to pay their property taxes. On top of that, they also have to pay utilities. They also have to pay for insurance. And on top of all of this, here comes the debt renewal, and they have to make your debt payments, right, for the loans on top of everything else with no occupancy. Where are they getting this money from? Now that looks like a bleeding corporation. So what is a landlord to do when their office property is vacant, right? They can't find a tenant to sign, let alone, their rates are going to be increased upon renewal. That means they're going to send that off to the renter. What are they going to do? They're obviously going to struggle making these payments. And that's the grim sort of commercial real estate outlook that we see sweeping the nation. With now remote workers, some people are in the office, some people are working from home, this sort of hybrid state, there's a lot of commercial real estate that are no longer needed because companies can save costs of maintaining property taxes, everything we talked about, management fees, all of this stuff, because they can just have workers at home. As I suspect, if the rates do remain high and it's cost more to borrow, the landlords for the commercial real estate basically have a few options. One would be to, find an occupant. Two would be to convert the commercial real estate into residential. 3, somehow find or restructure your business to generate more money that doesn't need a lot of people to be present in your office, like AI, automation, maybe even like Bitcoin mining. I don't know. They just have to find a way to make money. And number 4 would just to be selling the property. And that's why everyone's talking about commercial real estate, because we do expect a big shift. Credit tightening has happened, interest rates have risen. There's a lot of landlords that are going to be bleeding cash because they still have to, upkeep the property like we just discussed, right? So I am of the mind that there will be a big shakeup in the commercial real estate markets because landlords have a tough decisions ahead of them. Some of them will be capable to transition and renew and readjust. Others will not be able to renew, so they'll just have to sell, and this will create more loan defaults that are out there, and the market will have a correction. And there's others like me that are of this mind, not only like Morgan Stanley, but we also have Goldman Sachs. Goldman Sachs is saying that there was actually some fundamental problems even before the precedented, rate hike that we've just experienced of 500 basis points in the last 14 months, right? They're saying that there was a problem even before that in office properties. And it's not just mere due to these office vacancies, but the rate hikes as well has put a lot of pressure on the commercial real estate market. And so Goldman Sachs does share the same sentiment as Morgan Stanley and many people out there, that because of the high interest rate that the federal fund rates at and they expect to be paused, and also because of the variable rates that a lot of commercial office properties are also exposed to, there's going to be a lot of readjustments and coming up for renewals, and a lot of landlords won't be able to afford that because there will be bleeding money. Goldman Sachs also estimates that $1.07 trillion will be defaulted on when they come up for renewal from now till the end of 2024. That's only 18 months. That's not the 2 years we've discussed earlier. So in the next 18 months, by the end of 2024, Goldman Sachs really does believe their estimates that $1.07 trillion, over $1 trillion, will be defaulted amid the higher interest rate, the variable rates, bleeding money from landlords, and that will cause a drawdown as well. And if unemployment rates goes up, if money is not being generated by landlords, right, the interest rate is high, borrowers are not going to really want to make payments on things they can't afford because their credit worthiness will depreciate. So what are landlords to do? They're going to sell. And with landlords basically flooding the market with supply of commercial office real estate, that's going to push down the price. A lot of regional banks that also have these contracts for mortgages and stuff, they're going to reflect in their earnings. Year over year is going to be pulled back. That is going to affect the regional banks as well, as commercial properties are basically a derivative of what they do because they hold such a large amount of commercial properties. And Goldman Sachs does expect $1.07 trillion to be up for renewal and readjusted and actually defaulted in a much larger $1 trillion segment. And that's also a view that the Goldman Sachs actually has shared as well, that because of tightened lending standards amongst variable interest rates and high interest rates, not only commercial banks will be affected, also regional banks will be affected as well. And because of these factors, Goldman Sachs does expect pain to be in the commercial real estate market for the next few years. Now, to contrast Goldman Sachs, UBS, Union Bank of Switzerland, UBS also shares that since credit is still tightening further, it won't be as bad as the liquidity crisis of 2008. Now, that does not mean UBS actually does not expect there to be a credit crisis. They do, right? It just won't be as bad as some other institutions, right? Morgan Stanley, as we covered, Goldman Sachs, as we covered, and there will be a shakeup, and the structural problems are still there fundamentally. But they are of the mind it won't be as bad as the liquidity crisis of 2008. They do expect a large number of commercial real estate to readjust rather than default, right? So they are more optimistic. Now, UBS has shared that $1.2 trillion of a total of $5.4 trillion, not including multifamily, will be up for refinancing since they will be maturing. And UBS does expect this to happen during a higher interest rate phase. So UBS has expressed that $1.2 trillion will be coming up for renegotiations since they will mature. And amid the high interest rates that, other than multifamily, they will be coming up for renegotiations. And since the post-pandemic crisis has sort of changed the landscape of how many occupants are in these units, they do believe specifically the office sector of commercial real estate will be affected the most. So we can see now that UBS actually has a lot in common with Morgan Stanley and Goldman Sachs regarding their outlook regarding how the commercial markets will play out for real estate. But where UBS does differ is that they don't believe this will affect the commercial real estate sector as a whole. They believe that it's only 15% of commercial real estate that will be affected. And that 15% represents the office property sector within commercial real estate. So UBS does believe, like other banks, that there is higher interest rate that's going to create credit conditions and, properties are going to come for readjustments. But they specifically differ from Morgan Stanley and Goldman Sachs in this episode because they believe only 15% will be exposed to the credit volatility that may be coming down, and that won't change the commercial real estate sector too much. Now, since they really believe that only office real estate will be having the biggest sort of bearish effect, that is actually a lot more optimistic than Goldman Sachs and Morgan Stanley. Now, you let me know down below if you think this will cause a domino effect, right? Or if you align with UBS, where it's just going to affect the office properties and not be contagious into the commercial real estate. So overall, we do see major banks have an agreement regarding there will be a shakeup in the commercial real estate office properties, but they do differ, some differ regarding to what extent the contagion will be. The market thinks that the Federal Reserve funds rate will pivot later on this year in September and have a negative rate, making it easier to borrow to continue stimulating the economy. Now, there's a lot of reasons why the market thinks this way, especially the big actors. I'll get into that in tomorrow's episode. But the reason overall the market is very bullish on a federal pivot is because of global politics and how things have been playing out ever since what took place from COVID, with what treasuries, with what's happening in Russia, with their treasuries being, frozen by the US government, and how Russian allies and the rest of the world has observed this. And basically that's gonna be a whole different topic for tomorrow on the global political economic forecast and why the markets are bullish, because they really think the Federal Reserve has no other option other than to pivot their interest rates. But besides that, okay, so if we were to picture what one path would lead, it would basically be in this environment where credit contraction is occurring, people are going to be reducing their spending, and that is just as expected. Nothing crazy happens in terms of black swan events, nothing breaks in the economy, so the Federal Reserve doesn't really have to do anything other than just to pause, and this causes, people spend less and less because it's, the banks will just contract lending standards, and then that basically fizzles out into a soft landing, right? So that's one option where credit's contracting, people are spending less, and just slowly things are just moving forward in terms of inflation rate is just slowly being, pushed down again until we reach that 3% by the end of this year. The market has what they call a soft landing. That's option one that they see down a path. That's generally the picture for like a mild recession, right? It just blows over. So the second path is basically very much starts off like the first path, where there's a credit contraction, lending standards are still tightened, people borrow less money. But this scenario, rather than just fizzling out and the market is just having this soft landing, what happens is it actually breaks resistance in a way, and it starts dropping a lot faster than what we expected. And this doesn't cause a mild recession, it causes a irregular recession. But because there's a banking crisis and all this other stuff, and there's a financial, global political instability, all of these fears basically will be shown off into the stock market prices. And rather than just being, a bear market, which we already had a 25% drawdown from our peaks, it goes into a recession bear market, which goes down to 40, even 60% drawdown from our peaks. That leaves us with another 25% drop at least, or around there. And so this causes your regular bear market recession rather than a mild soft landing. So the Federal Reserve in this situation, the second path, will basically be between another rock and a hard spot, because here we are, the economy and the markets have calmed down quite significantly, and they have the option of, should we keep the rates at where they are at 5% and let this sort of play out just because of the massive amount of stimulus that was created back then? Or should they stimulate the economy with their quantitative easing tactics and bring the economy slowly back up to, correct from this bearish recessionary sentiment? Now, the quantitative easing sentiment has already begun, but it's sort of like unofficial. Treasuries now, if they're held by institutions or entities, and they've lost 35% and only 65%, and if you bring them up to market, Federal Reserve has promised that if you bring your treasuries back to the Federal Reserve, they'll give you mark to market and 100% on the dollar rather than 65. So that is still like a backdoor quantitative easing. They're not really calling it that way because only big sovereign funds, family estates, well, actually even bigger than family estates, countries and big players in the market really have these treasury funds. So it is quantitative easing, and that might trickle down later on. The day-to-day person, the day-to-day investor isn't really holding that and going to cash it in at the Federal Reserve. So that quantitative easing tactic isn't really forefront, right? It's indirectly, but it's still there. That's why the markets are doing so well. So everyone has an opinion. The question is, where is it going to go? Will, the Fed pivot and start, stimulating the economy again? Or will they hold strong and try to battle inflation, have unemployment rise, and that basically get rid of inflation? Which one will they do? Let me know what you think down below. So the million-dollar question is, Basil, what are you doing to, prepare yourself in this credit crisis? So because it's a credit crisis, you want credit, meaning liquidity, meaning cash. Hold some cash. According to my portfolio, this is just my opinion, I'm not your financial advisor, even though I am a financial advisor, is I'm holding some cash, right? I want to buy the discount. I want to buy when, there's blood on the streets and things are Boxing Day sale, Black Friday, and, all of those good stuff. All together, when everyone is in fear, I want to go in and buy the dip, and that basically means I need liquidity. I need some cash, And so I have some cash. I have about 40% of my portfolio in cash. That includes treasury bills, short-term, 3 months, 6 months. I have some money markets just to give me some yield between 4.5% and 5%. That way I'm able to readily, sell those and move forward with my purchases when I see an opportunity. So that's one strategy. The second strategy during this credit contraction is you want to hold some precious metal, right? That's what I did. I'm holding some precious metal. I have gold, I have silver, I have that, and I have Bitcoin as well, because it might perform like a precious metal, but it's considered more of a higher risk just because it's so brand new. It's still like in its early teenager phase, right? It hasn't really had that maturity, but it's growing well. The hormones are balanced. It's doing well around the planet. It's raging as a teenager. It will be volatile, but when it matures, I really do believe there's going to be a bright future for Bitcoin specifically because of its properties that it has a max supply, proof of work, creating not only the security for the blockchain and it self-audits and all these amazing stuff that you want in basically sound hard money. But gold and silver is also very important because it's tried and true. We have a gold that has been around the planet for thousands of years through up and downs of many civilizations. Silver being sort of like the nobleman version of gold for smaller day-to-day transactions. So it's good to have 1 ounce silver coins as well, just to start stacking them just in case. This is again insurance against what would happen if the fiat system kills over during like a Great Depression or stagflation, for example. And alongside gold and silver and Bitcoin, there's some opportunities in gold miners. I do have a little bit of exposure. I'm still getting into it just because I'm more of like, if it's in your hand, it's real. If you have your own private keys, it's real. Gold miners are a bit more of like a government play because, they can always be seized or nationalized, as we see around the world happening. But there's certain opportunities to purchase gold miners that are a really good opportunity as well. The remaining of my portfolio will be in equities. Equities right now are looking good at healthcare and technology right now. I'm going a little short in the near term, but I had a really nice higher high, and I do expect positioning where it's going to come down a little bit, but that's more alongside my short-term 3 to 6 months play. And I have some other equities and I'm playing commodities as well, such as uranium. I do like that, a little bit in EV and other sectors as well. I don't want to get too much into my equities. That's basically the strategy, where you want some credit, you want some commodities like precious metals, Bitcoin, maybe some plays in uranium, and you want some opportunities that you've already purchased in the past where you're holding in profit, the equity side of things. So that's my overall personal profile, where I have up to 40%, can range between 30 and 40 in cash equivalents, where I'm investing it and getting a yield. Yes, the yield isn't as high as, say, the interest rates that we're experiencing with inflation, but the real interest rate, because it's around like 4 and inflation is quoted at 5, a real return of -1, meaning my ice cube's only melting at 1% a year. That is fine. It's better than, drawing down another 25%. So yeah, cash equivalents, commodities like Bitcoin, gold and silver, and exposure to some, gold miners as well. And the remaining being in certain equities, a little bit of like more of like what I've already had. So it's not like I'm really purchasing new equities. There might be an opportunity when something is like on a new IPO to be purchased. But right now I'm sort of holding that dry powder, waiting for the market to correct, because, when people are so frothy and things are really good, I just want to sell, even if it might go up a little bit, I might lose some opportunity in making some extra cash. That greed is not going to be a factor for me. I don't care about it because I've sold incrementally at the top, and as things get bad, I'm going to be buying incrementally as things go down. That is a fine strategy for me. It has worked very well. All right, so that's generally how I structure my own portfolio. I'm not your financial advisor. Do your own research, but you can ask me questions on what I'm doing. I don't mind at all, and I will answer those down below. So the CPI numbers will be coming out fairly soon, later this week, and I want you to make sure that you're subscribed. That way you can catch the benefits of analyzing that, whether to see our thesis is correct or whether our thesis needs revision, and how we expect the markets to play out. If CPI continues to meet expectations or actually outperform expectations by dropping, then things are going as well as we planned. We might see a small bounce in the market. If expectations are not met and it's a lot higher than what we anticipated and inflation is a little bit more sticky than we expected, then we will see a drawdown on the stock market and basically creating some opportunities. Perhaps it takes down gold and silver a little bit. Have a good entry position for more of a long-term play. If gold hits 1950 or even 1900, that would be perfect time to buy in. That's what I'll be doing anyways, not your financial advisor, but that's what I'll be doing. So with the CPI report, there's some other strategies regarding how we will see the federal funds rate change, or whether the real estate market, whether it's residential or commercial, how those property prices will change. And this is why it's super important to keep track of how things are going to be unfolding in our markets. You know, will the interest rates be paused? Will they increase? Will they pivot later on? It's important that you subscribe so you can follow the latest and get the best strategies as I unfold with new episodes with global political outcomes and why gold and silver will be doing very well. There will be exposures to certain equities when they pull back that I want to share with you as well because of my performance in my portfolio that I will share with you so you can do your own due diligence. And with the interest rates so high, with, you know, variable rate being affected in corporate loans, national debts, commercial real estate, you know, variable rate for residentials, and, you know, lending structures such as credit cards and personal loans also being affected, there's a lot of credit crunch that will happen. If the Federal Reserve does pause for longer, that may cause a soft landing. I don't believe that, but I would like to be hopeful nonetheless. Now that we understand what big banks are more thinking along the lines of commercial real estate office properties and $1 trillion, us being exposed to defaults and refinancing and who will do it and who will not, at the end of the day, these loans are held at banks, right? And the banks are basically usually in ETFs, indexes, they're in mutual funds, and they're traded around the world through subsidiaries and derivatives and other packaging structures like mortgage-backed securities. So we don't know how far this contagion will be, right? It's important to stay defensive during times like this where it's uncertainty. Credibility is key and liquidity is king during shopping prices, right? We want to make sure we buy the dip when a lot of commercial real estate, whether you're into that sector or residential for income or just maybe corporate, you want to buy some shares in a company like a stock and you want to buy it at a discount. You want that dry powder for the future. We'll share what I will be doing when things unfold. So make sure you like, comment, and subscribe if you enjoyed. Thank you for joining us here at the Financial Almanac. I am Basil, and I'll talk to you guys later. Bye-bye.